Well, the market surely is looking very cheap to some investors at 9 times forward PE. So I think that is one thing that is going for Chinese equities at the moment, compounded with this expectation of a gradual recovery in the economy that will provide some support for earnings going forwards. Now, in order for us to see this recovery, we need to see two things. First of all, of course, we need to see a pivot away from zero COVID. And we maintain our view that that might actually take longer than expected. So we are looking at a gradual inflection after March. But of course, between now and March, they will try to shift the tone and they will try to tell local governments to be much more targeted in how they implement some of these lockdown measures. So that could help. Investors are definitely getting very encouraged by some of the changes in tone, perhaps a little too soon. But nonetheless, we do expect that this will be gradual and after March. The second point, of course, is sustained support. We are still in the midst of a deceleration. I would even call this stagflation for the Chinese economy, given that now we have deflationary pressures. We probably will see that this week, but we also have growth below its long-term trend. So for an emerging market, that would be classified as a recession. And so the central bank and the Ministry of Finance will have to continue doing monetary and fiscal policy easing into 2023. So the December Economic Work Conference should provide a blueprint for that. And that is the other catalyst that we are looking in order to sustain this rally in Chinese equities that we are seeing this week.
And Carlos, with exports in trouble, what growth drivers does China have to lean on right now?
Yeah, absolutely. So the exports, as you rightly mentioned, have been one of the bright spots in this more slower growth environment for China throughout the whole of the COVID period, to be quite honest. That engine is definitely starting to fickle, with rising risks of recession materializing very clearly in the Eurozone this winter and in the US going into next year. That means that the domestic demands, the domestic consumption in China will have to step in to offset some of the downside pressure from weaker external demand. And we are not there yet. So we are not yet seeing a pickup in domestic demand. That will not happen in a sustainable manner until after they manage to reopen, at least domestically. And so the risk here is that we have one or even 2 quarters of very subdued growth because we have weaker external demand, and domestic demand proves very sticky to pick up.
Yeah, Carl.